Hello there, this is Bruce at Fleet Capital Management. Today is Saturday, the 30th of September, 2023. We have now, as of yesterday, completed the September trading month and the third quarter of the year. And we're going to take a look at what we might expect going forward. I think you might find this interesting. As always, we need to say the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. Any questions, I'm always available, as you know, Bruce at fleetcapitalmanagement.com. Here's our homepage. Just to remind you, and this is fleetcapitalmanagement.com, two buttons on the right-hand side. This bottom button will take you to the most current weekly market analysis videos. The top button will put you on my schedule so we can talk one-on-one, which I always encourage. If you have questions, please feel free to use this. I think not enough people are using this when they have questions about the market or what's going on with their accounts. So please use that. I've shown you this many, many times. Mostly we were looking at this for August and September. This is seasonality, showing that August is a pretty lousy month. September is the worst of all of them. It played out exactly as we had anticipated. Last week, I told you that Tom Bowley did even a further study that showed that the week ending September 26th is the worst of all of them. And again, that played out exactly. It doesn't always work that way. But now we're moving this way. We're moving into the final quarter, which is usually a pretty strong quarter. And we are going to be positioned for that. But I'm going to show you in this video the when. When do we get back in? Because Monday is the beginning of October trading, but we're still have not built up our allocation yet. So I'm going to show that all to you in just a few minutes. This is our chart that we look at once a week. This was updated yesterday, the 29th. You can see the first two columns are based on daily indices. That's what the D means. This is the hull, which I'll show you. This is the more important column. This is the 8-day moving average over the 21-day moving average. Both of those are and have been in the red. Going to the second set, this is, you can see the W. These are based on weekly analysis, again, which I'll show you in just a moment. The hull has been down. The go, no-go trend is still in and up, which is interesting. And I would probably agree with that. The third set of numbers is the D, daily moving averages. A bull market has the 20 over the 50 and the 50 over the 200. Right now, the 50 is over the 20. We call that a correction. Remember, in the market, the phases are pullback, correction, bear market. We are not in a bear market. If these numbers were the 200 was over here on top of the 50, it would then be red, and that would be an indication of a bear market, which we are not in. The most important bear market indicator is probably the 10-week is over the 20-week. You can see we've got the W there for weekly. And so we are not in a bear market. I'm not saying things look great. We are definitely in a correction, but we may be getting very, very close to the bottom of that correction. So let me show you some things on charts. Let's go to the go, no-go first. Always looking at the S&P 500 as our most general guide. The left side is weekly. The right side is daily. You can see we've had a pretty dramatic, this is that week that Tom Bowley said would be really bad, and it was. And I have this light blue line is the 20-day, and then the gold is the 50-day, and the red is the 200-day. And you can see the 20 is below the 50. That signifies a correction. To be in a full bear market based on this indicator, that gold line would need to cross below this 200-day, the red line, and we're nowhere near that. So I don't believe we have much of any chance of going into a bear market, although anything can always happen, but I don't think that's going to happen. It looks to me like we might be forming a bottom here. We'll see. And we need to get this 20-day moving back up. On the weekly, this green is the 10-week and the red is the 20-week. This is our primary bear market avoidance. You can see back here, a little bit hard to see, but the green crossed below the red, and that would have been the beginning of the bear market as far as this indicator. And we would currently, if that happened again, we would be in cash, and we would miss all of this downside. And based on this one indicator, and we use multiple, we would have gone back in somewhere right around here. Yes, it would have been choppy, but we would have gotten in ahead of the strong bull push. This candle still signifies a bull market based on the go, no-go analysis. So all of this gets converted over to here, and these numbers all come off of those charts. So what are we seeing here? Price has not gotten down to the 200-day moving average. That's good. 200-day moving average. If the 50-day moving average does not act as support, which it didn't in this case, then the 200 is the next area. I don't know that we'll even go down there. So that's the story on the go, no-go charts. On my primary chart, what I have here is the white line is the 8-day, the blue is the 20-day, then the gold is the 50-day, and here again is the 200-day. The reason I have the 8-day on here is because when the 8 crosses below the 20 or the blue, that's a pullback. When the blue crosses below the gold or the 50-day, that's a correction. And then again, a bear market would be when the gold 50-day crosses below the 200. We're not there yet. So what I really, really want to see from this chart, and what's going to cause me to start adding a lot of securities, is when that white line, which is an 8-day moving average, crosses above the 20, and especially when it crosses over the 50, like it did here. You can see that we were in a pretty strong bull market, bear market, not bear market, I beg your pardon, but a kind of a correction market here. Looks very similar to this. And when that 8, the white line, crossed above those two lines, is my signal to get back in or start to get back into the market in a serious way. If we look at the NASDAQ, you're going to see that it's very, very similar. The NASDAQ has done actually a little better than the S&P 500. It looks a little bit more clustered here and looks like it's turning back up. But for general purposes, we use the S&P 500 as our guide. I hope that makes some sense. A couple other things that I'm seeing here. If I put back on the hull, you can see this is just a very fast moving average. We're still in the red. I would expect to see the hull turn up as it did here. It got green even before the 8-day crossed. So the hull is an early indication warning. We're still red, so we're not there yet. That's why I'm not fully invested yet. On the linear regression, I need the price to get back above this blue line, which is 2 standard deviations below the mean. It did get back up above, but it closed here. So just slightly, and you can see that it looks like we might be forming a bottom here, and I'd like the price to be inside that linear regression. We're not quite there yet, but we're close on a lot of these things. So what I'm trying to show you is, even though October is considered a very strong month, many times October will start, the first 2 weeks can be volatile and sometimes down. The real bull market on seasonality starts 3rd week of October. So what I'm doing is watching very, very closely what happens with these technical analysis. And again, what I want to see is this. I want to see the white go above the blue, which is the 20-day, and that's going to be my trigger. And this is a very fast moving average. It's 8 days, and that could happen anytime. I mean, it could take a week or so to get in there. So that's the overall market. Another thing that I'm seeing with the market that could be an indication of a bottoming, if we come down here to the TSI, which stands for the True Strength Index, look how low this blue line is. Now, granted, we want these above the 0 line, but many times a upward market will start when the blue crosses above the red. But look how low this is. If we look left, let's look to, let's see, back here it was below and then it turned back up. Back here was a real significant low, and you can see how it crossed back up. And if you look above, it kind of started the upward trajectory for the market. So what this is suggesting to me, as low as this is we're probably very, very near a bottom. I don't think we're there, but we're we could be, but we're very, very close to the bottom. So that's the overall market. The other thing I wanted to show you today is I monitor thousands of stocks, but They have to meet certain criteria before they actually get onto one of my lists. So if I go to Stock Watch, this is one of my lists. A number of people have asked, why are we not in Apple? Apple had this huge run and it pulled back and it has been bouncing. But again, now that you understand some of this moving average part of technical analysis, I would want to see this white, the 8-day cross above, which it did here. But again, we were still below the zero line. So, a lot of things have to line up, but here's a reason why we're not in Apple yet. I want to get into Apple. I think Apple's one of the, if not the greatest company in the world. And I want us invested in it, but it's just not the right time yet. We've been in Massey before. We got out of Massey, we were stopped out, and look what happened. This is just showing you what happens sometimes when we're stopped out. So, Microsoft, I want to get back into Microsoft. We're not very far away. Again, it looks a lot like the NASDAQ, but we're just not there yet. So I can't pull the trigger on it. Here's one that I'm about to pull the trigger on. This is SMCI. This is a supermicro computer. It's the chip maker. And look at that white line dramatically getting back up. It's touching the blue. If this gets a little bit higher, I'd like to see price come back down and fill this gap before it returns. But this is a stock I'm very close. Look how the blue down here on the TSI has crossed. Look how the green is back above the red, but still not strong. The triggers for me to get back into this is that white needs to be above the blue. I want to see this moving more towards the zero line. And I would love to see this white line, it's called the ADX line, cross above that red line. So it could happen quickly because the red is falling, the white is rising. If those things happen, if that confluence of analysis happens, we will own SMCI. Let me show you a few others. There is a stock, an industrial stock called MOD or Modine Manufacturing. Look at how the white 8-day just barely crossed above here. That is a buy indication for me, but the other two haven't gotten there yet. We're very close to the TSI crossing above. If the TSI crosses above and the white stays above, you will see that we will own this stock. I'd also, like in the other, I'd love to see this white ADX line cross above that red DI line. Again, all these things are indicators that they're not guarantees, but they put a lot of things on our side. Another stock that I've been looking very closely at is CrowdStrike Holdings. You can see the white is above the blue or the 8, and you can also see the green, and this is about to cross. So we're not there yet. We're really close on this one. So my point is I use a number of screens that screen thousands of stocks, and the ones that make it into these lists are the highest quality of all of those that I'm screening. So even behind the scenes from here, these are the best of the best. And then I use technical analysis to help us time, but I'm looking at thousands behind there. And here's our ETFs. I'll show you an ETF that I really want to get into. This is called Global X Artificial Intelligence. You can see it might be starting to turn back up, but it's not there yet. But that's an ETF that I really, really want to get into. I want to add Moat to our more conservative, class 2, class 3 accounts, risk class. I really want to get back into Moat, but again, I can't justify it until we get a little bit of a change here. There are some dividend portfolios that I want to get back into. Can't do it yet. It's just not showing me that it's the right time. Energy has been a huge, maybe the biggest winner. We may be getting into this XLE or some individual energy stocks very soon. I need to see this cross back up. I need to see the green cross back up above the red. This may be just taking a breather, and then we could possibly go higher. And finally, I'd love to get back into XLK, which is a pure technology sector, but I just can't do it yet. Here was our stop. This caused us out, and I just haven't seen reasons to get back in. So my point is, and I'll end here, my point is There's an awful lot of work that goes on behind the scenes, just thousands of stocks being screened for a number of different factors. We only buy the best of the best, and then we use technical analysis to time our entries and exits. So that's how all of this works. I hope that makes sense to you. Like to see some green on this chart, but we're not there yet. But I think we're really close. We are moving into a positive time of seasonality starting on Monday. But again, the first 2 weeks of October are generally pretty volatile before something takes hold. We also have the UAW strike, which continues on. That's a big negative for the economy. We have a government shutdown, which is imminent. It is tomorrow if they can't figure out how to fund the government. The interesting thing on this particular government shutdown is it doesn't seem like the Republicans are blaming the Democrats. The Republicans, there are a group of Republicans who are not allowing the rest of the Republicans to pass a spending bill. So this looks like an inter-party play more than Republicans blaming Democrats, or Democrats blaming Republicans, which is the norm. So this one looks a little bit different, but that's why those two things, especially, or three, I'll say, rise in oil prices, potential government shutdown, which won't last, it never does. All of these things are playing into market psychology. Those will all go away probably in the next couple of weeks. So I will very slowly, the beginning of adding will be very slow. And then as the technicals shape up, it'll get very fast over a day or two. So yes, that's what I want to see happen. This has been a little bit longer than normal. I apologize, but I wanted to share that with you for many who are interested. So thanks a lot. Have a wonderful weekend. If you have any questions about anything that I've covered, always give me a call, shoot me an email, or jump on my calendar so we can do a Zoom and talk one-on-one. I'm always here for you, always available to answer questions, and have a great weekend. We'll talk to you soon. Bye-bye.